Hello, this is Bob Steele. In this video, we will be talking about gross income and how it relates to the income equation. Our objectives will be, we will be able to define income as it relates to the tax code, define and compare cash basis and accrual basis methods of reporting income and expenses, list types of income included as taxable income under the income tax code, list types of income that are excluded from taxable income under the income tax code. So first, let's start by looking at the accounting equation. Here is our accounting equation once again to bring us to taxable income. This is a form of an income statement, and what we're going to do from here on is we're going to try to drill down on specific areas within this equation, starting at the top with gross income. So we're going to start with gross income, and this seems like a simplified topic because when we think about accounting, we often think that income's pretty basic. What is income? That's what we earned. But when we start talking about individual income, it's a little bit more complex. What is included in income? What is not included in income? It's a little less straightforward. What if we just found $100 on the ground? Is that income? What if we got an inheritance? Is that income life insurance? Is that income a gift? Is that income? So we have these types of questions that are much more complicated in terms of what's included and what's excluded. So we're going to have to first take a look at that line and see what should be within the income section on the income statement. So income is generally recorded on a cash basis for individual income tax payers. So first, to understand that, let's compare the accrual basis versus the cash basis. The accrual basis is, of course, what we've learned in accounting classes. So if we take the accounting classes, we've been learning on accrual basis. So generally accepted accounting principles generally teach accrual basis methods. The reason we teach accrual basis methods is because it's usually better for decision making. So if we're trying to make financial statements in order to make decisions, we're going to use the accrual basis method. If we're trying to make financial statements for the taxes, we'll end up using a lot more cash-based principles. And in reality, we're usually kind of in the middle on somewhere. You know, the financial statements are more accrual, mainly accrual, and the taxes tend to lean a lot more on the tax side, although everything's probably hybrid. Those are extreme positions on either side. So why would the tax code do it in this fashion if it would be better for interpretation of income to do an accrual basis? And the answer is generally because it's easier. The IRS wants to be able to tie out exactly what is going on. They want to be able to have an audit if they need one, and it's easier to see, hey, can you prove what happened in terms of did you generate income or not? And it's easy to prove that if we can say, oh, here it is deposited into the bank statement or taken out of the bank statement. So those things are going to be easier to prove. It's easier for the IRS to ask for things like W-2s and 1099s on a cash basis method. Therefore, will be in a cash basis method even though it's not as efficient or as good in terms of decision making. So to compare and contrast those, let's take a look at the definitions of the two at this point. So an accrual basis method means that accounting concepts based on two core concepts. The revenue recognition concept, which of course we are concentrating on at this time because we're focusing in on the income section of the income equation or the tax equation. So under the accrual basis method, which is what we are not using because we're going to use the cash basis, we're going to use this as a comparison to the cash basis. Under the accrual basis, revenue is recognized at the point in time when it is earned, not when cash is received. In other words, revenue is recognized when the service is substantially complete or when goods have been delivered, whether we have received cash at this time or not. And you can see that that's basically a better recognition of when we earned the revenues. That's a better idea of when revenue was basically earned, when we did the work. That's when it was earned, whether we got cash or not. On the other hand, on the matching principle side of it, which deals with the expense side of it, which we'll talk about later when we get into deductions, we're going to match the deductions to the expenses because that's where that ties out from the accounting to the taxes. So expenses are recognized at the point in time when an asset is consumed or a liability is incurred in order to generate revenue in the same time period. So basically the matching principle is the expense side of the income statement, and it says for the most part when we use whatever we're using in order to generate revenue in the same time period, not necessarily when we paid for it. And on the cash base, in comparison to that, in contrast to that, we're talking about revenue is recognized when cash is received and expenses when cash is paid. For the most part, that's what the tax code is on. So for the tax-based purposes, we're going to be on the cash basis method. Why? It's simpler to do. It's easier for the IRS to tie down. If there's an audit, it's easier for the IRS to ask for documentation and be able to verify that with individual taxpayers who may be less organized than a publicly traded company who would be on an accrual basis method, and we would have different methods in order to try to tie their financial statements down. The goal of the financial statements being different than the goal of taxes. The goal of taxes to generate revenue and have social policy. The goal of the financial statements is to provide something on which decisions can be made for the public, being the investors, usually is the main goal of regulations for the stock exchange. So first, let's take a look at the tax code as well. So when we're talking about taxes is obviously a law. There's a law for it. We can look at the regulations, the code section for it. This is code section 61A. Definition of what income is under the tax code is this is just a portion of it. And except as otherwise provided in this subtitle, gross income means all income from whatever source derived, including but not limited to the following. And we'll go over some of the items that are listed. What I want to point out here is, of course, the underlined portion here saying that income from whatever source. So the default position for the IRS is that anything is income. So unless the IRS says otherwise, their default position is that it's income. So if there was a questionable item and we went to the tax court on it, the IRS basically has the advantage for the most part with this definition, because their definition starts with everything is included unless we say otherwise. So it's not like we're going to list the things that are included and that's how it's going to be. They're saying we're going to assume that everything is included whether we mention it or not, and then we'll tell you what is excluded. So note that position, that point of view when we're trying to go through this list of types of things that may or may not be included in the tax code. So here's a list of items included as taxable income. So we'll just try to name some of the common stuff. We'll go over some of the common items and say, hey, will this be an income? Do you have to report this on your 1040, or do you not have to report this on your 1040? And of course, when we're talking about income, we're hoping we don't have to report it on the 1040. Unlike on the financial statements, when we're trying to look good, meaning we want a lot of income and few expenses, meaning we want net income to be high. Obviously, the opposite is true for taxes for the most part. We want to report less income because we want to pay less taxes, and we want our expenses, or deductions in this case, to be higher, which will make our net income as low as possible, and therefore we'll pay the least amount of tax. So that is the objective that we have. And the first thing that we obviously have to include is the W-2 income. So W-2 income, meaning wages from employers, will be included in taxable income. Want to point out the forms here, the form of course being the W-2 in this case, and the forms are a way for the IRS to really tie down wages. So we self-report our income. We're required to report any income that we have, whether we get a W-2 or some other form or not. But be aware that the W-2 basically means if someone gives us a W-2, it helps us to report our wages. But what it's really also saying is, hey, you know what? Who else got a W-2 that I sent it to? The IRS. The IRS has a W-2. So if we do not report this on our taxes, the IRS will almost for sure audit you. It's not like even a random chance at that case. They're just going to line up the W-2 and say, this hasn't been included. You will almost for sure get an audit, get some kind of letter saying that this income has not been included. So that's what the IRS is going to try to do as much as possible. They're going to try to tie everything down and back everything up with the backup from the person who pays the other person. So an expense to one person is income to another person. And you might say, well, why do employers comply with that? And obviously, they want to take the expense. So if one of the largest expenses for an employer is wages. So they have to report the wages. And if they report wages in order to lower their tax, then they have to report the wages to the IRS, and the IRS will then record the income on someone else's taxes. So in order to get the expense for the employer side, they must report the W-2 and thereby record the income on the employee side, and that's how that works. The 1099 interest, we're going to talk about different types of interest, but the main types, of course, being bank interest, interest from a CD, interest from some kind of investment, usually a CD or savings account. That is going to be required to get a 1099 interest on it. So whoever is holding, the bank that's holding, or the bond that you have, is required to generally give a 1099. And notice a 1099 is the same idea, meaning the IRS is requiring the bank to give a 1099, and the 1099 once again means, you know who else we sent the 1099 to? We sent it to the IRS. So if we do not report this interest on the taxes, you're almost for sure going to get an audit, because that's something that's going to be clearly verifiable. It's going to be on there. So any 1099 that we receive, of course, is clearly revenue for the most part. And dividend income is going to be the next item. Dividends are a little bit more confusing for some people to think about. Dividends are generally going to be the income that we receive from a company as the owners, usually from publicly traded companies, meaning we're the stockholders. So we're the stockholders who are the owners. We have very little control if we're just common investors, but we do have voting rights, but they're usually fairly small. So we have to represent the income when we receive the payments. Now, there's a bit of a debate on dividend income because, of course, if we own a company, if we're the owner of the company, and the company is a C corporation or publicly traded company, then the company already paid taxes. They had to pay taxes on their tax return. Then they give the money to us, which is just like a distribution. If it was our sole proprietor, it's similar. We're now getting the money that the company that we own earned. And of course, we're getting taxed on it again because we're getting taxed on the dividend side. So later on, we'll talk a little bit about the fact that many people would argue, and right now there's a lower tax rate for certain types of dividends. And one of the reasons for the argument for that to be fair is that it's double taxation. And of course, the argument against that is that higher income folks basically have dividends opposed to lower income folks, and therefore it's a tax against the lower income folks. And two, if you're not actively a decision maker in the business, then even though you're a stockholder and you're an owner, it's not like you're actively participating in the business. It's kind of a passive thing, and therefore you should be taxed on it as income. So that's a debate that's currently out there. State tax refunds, this one's a little bit confusing, but see if we can break this down a bit. If, for example, I live in California, California has a state income tax. California has almost no tax that it doesn't like, so of course it includes the state income tax. And that means that we pay the federal income tax and the state income tax. So for some reason, the federal income tax decided that certain state taxes can be deductible. And so the income tax is one of those that is deductible. Now, for example, if I pay $1,000 on the state income tax in this year, I get the deduction when I paid the tax. So if I paid $1,000, I get to deduct $1,000 as an itemized deduction. Now, if in the next year I overpaid the state and I really only owed them $600 and I got a refund and they gave me $400 back, then in the next year I'd really have to report that refund as income. Why? Because I deducted $1,000 in the prior year, and really I only paid $600 in taxes because I got a refund. I got a refund on, in that case, of $400, and therefore whatever refund I got, I would then have to report if I took the deduction. So that could be a little bit confusing. Some states do not have an income tax, such as Nevada, and they might have a sales tax. So that can be a little bit, that's another reason why this deduction's a little confusing, because it can influence the way states tax their people within the states. And sales tax has different rules as well in terms of whether it can be deductible. That was added at a later date in order to compensate for states that decide not to have an income tax, decide to tax people differently. And of course, states have a right to do that. And so sales taxes can be deducted under certain types of rules as well. And like DMV types taxes and local taxes are items that can be deducted. Property taxes is going to be an item that will be deducted, which again is a local tax that can then be deducted. So the Social Security benefits being the benefits that we receive at retirement. So these are going to be the benefit that we get back when we retire because we paid in the Social Security throughout the throughout our working time period. So therefore, when we get the Social Security back, it has to be included in income, but because Social Security is a form of a safety net type of payment, we don't want to basically have low-income folks obviously paying a lot of tax on the Social Security because it is a safety net payment. So there is going to be a phase out. We'll talk a little bit about that, but basically there's going to be a phase out on lower income individuals will pay less of the Social Security tax or have to include less of the Social Security benefits in income as higher income folks. Jury duty. So if you go to jury duty and they pay you on the jury duty, then that would have to be included. Prizes and awards is an interesting one. We might have heard that if you win the lottery or something like that and you won $1 million, then you would generally have to pay taxes on that $1 million. And of course, if you collected that all in 1 year, then you might be in a higher tax bracket than you are used to being in, and you might have to pay a lot. If you won something like a car, like a $200,000 car or something like that, the taxes on the car may be actually more than the money that you have to pay for the car in some cases, and you may have to sell the car in order to pay the taxes on the car if you want a very expensive car and some kind of award or something like that. So it's an interesting topic, interesting area. Forgiveness of debt would also have to be included in income. This could be confusing at first because the forgiveness of debt can be a little confusing, but if you think about it, it makes sense. And if we think about a scenario like this, if we say that we are working for our employer, and let's say we had a bad month and we asked our employer to give us a loan of $5,000 to help us out, and if they did so, and then sometime in the future they said, okay, you're doing, we're going to try to pay back the loan, so this work that you did, instead of us paying you a paycheck, we'll just forgive the debt that we paid prior. If you think about that, obviously we still did work, we still earned income, we still got income, but instead of receiving a check, we got the forgiveness of the debt that we would have to pay back. So it'd be just like if they paid us the check and then we gave it back to them to forgive the loan, it would still be income. So just the fact that the money didn't go back and forth doesn't mean that income didn't happen. Cash or a check is not the only form of income. Forgiveness of debt would, of course, be a benefit and therefore would be income as well, which has to be included on the 1040. Insurance proceeds in excess of the adjusted basis of property. So if we got like in a car accident, or if a building burnt down or something like that and we had insurance on it, of course the proceeds of the insurance, in order to compensate for the cost of the property that we lost, would generally not be included in income. But if for some reason we got more money from the insurance company than the value of the property that we lost, then we would generally have to include that excess value in income. Interest. So let's talk a little bit more about interest. We talked about it for a second there. Let's talk a little bit more. Interest can be reported on a Schedule B, and some interest is tax exempt if the debt is issued by a state or the U.S. So the classic example is a U.S. Treasury bond. So obviously we're paying taxes to the U.S. government. If the U.S. government wants a loan, meaning they want to issue bonds, they want money from the citizens by collecting money and issuing bonds, then of course they have the ability to be able to say, yeah, and we'll give you tax-free bonds, and we won't tax the bonds. So that's the benefit that the government has. Usually government bonds are going to be very safe too, so you're usually not going to get a lot of interest on the bonds. But the fact that they're safe and you don't have to pay taxes on them is a nice part of a portfolio to have in terms of you're not going to make a lot of money probably because the interest rate's going to be low even though it's tax-free. But a lot of people like having government bonds because they are very safe, and that's a good check in a portfolio. Dividends. So we talked about dividends a little bit already, and we just want to expand on certain types of dividends at this time. So dividends will also be reported on the Schedule B, and we have a certain type of dividend called qualified dividends, and they're taxed at reduced rates. So Remember, we talked about a dividend is a return of income on a company. So we own the company as stockholders. The company earns money. They pay taxes if they're a publicly traded company on the money. Then they distribute that money to the owners. Now, most stockholders are not, big decision makers in the company because they own a very small portion of the company. Therefore, the investment's pretty passive. And therefore, we basically will have a double taxation. When we get the dividends, we generally have to pay taxes on it. In order to incentivize the market, as well as deal with that double tax problem, we have a rule that basically the domestic corporations will have a reduced tax rate. So domestic dividends will have a reduced tax rate than what will be as ordinary income. So in order to explain both the Schedule B and the idea of having different schedules, I'd like to take a look at an Excel worksheet here and take a look at this in terms of Excel. We could also take a look at it in terms of the tax return, but notice the tax return has a lot of input areas that may not be used. So a lot of times I will use an Excel spreadsheet to back up the numbers and give me an understanding, and we can see formulas in, of course, an Excel sheet and see how the entire formula ties together, and it works similarly to the schedules backing up the 1040. So let's take a look at that. So here's an example of an Excel sheet of the formula that we have here. And we're starting with gross income, and then of course we have the deductions and adjusted gross income. We're focusing in here on the gross income. Now, just like it would appear in the 1040, we may have different lines that will then add up to the total being the gross income, and we may have different schedules that will include in that. So notice we've listed all of these things that are going to be in gross income, and we're going to have to somehow group those. So a lot of times we'll have different schedules, which can be thought of as kind of different sheets on an Excel tab. So if we take a look at this and go to the income worksheet, I'm going to have this tab, which will basically be interest and dividends. So this is similar to the tax return. We're going to have a different worksheet adding up the different interest amounts. So if we had two types of interest payments from two different bank sources, we would add them on something like a Schedule B, and we'd come up to something like this. And then, of course, if we had dividends, we would do the same type of thing. We would add these up, and we may have multiple kind of areas where we got dividends, and they may be qualified, they may not be qualified. So, for example, we may have dividends here of 500 and 300. Now we've got the 450 and the 800 add up to 1250, and that 1250 would be part of gross income. So notice that gross income number, that bottom line number, is going to have to somehow be formulated. A lot of times it's easier to think about that in terms of an Excel worksheet. That's basically how the 1040 will work. They'll pull them in there. And it's easiest to see if we look at formulas in this way, if we look at the equation in this way, and we trim this down. Now, notice that these two items, which are included in gross income, if they're going to be ordinary, if they were non-qualified dividends, they're going to be taxed as ordinary income. If they're qualified dividends, then they're going to be taxed at a reduced rate. But when we look at the bottom line number in gross income, they're both included in there at the same amount. So that can be confusing when we start talking about it at this point, because whether they're qualified or not makes no difference here. Where does it make a difference? When we calculate the tax rate down here. So when we come down and we finally calculate how much we owe, we're going to have to look at tables, and we're going to have to look at the progressive tax tables, and then we're going to have to pull out the qualified dividends and tax those at a different rate. Almost everybody uses software in order to do that now, because that's going to be somewhat complicated, because now, of course, we have different rates for the income that's not qualified dividends. Then we got to pull out the qualified dividends and tax them at the reduced rate. And we'll talk later about capital gains, which will have a similar scenario related to it. All right, so when we got the Social Security, we talked about the Social Security benefits, meaning the benefits that we're going to receive at retirement from Social Security are going to be in this section. That's what we're talking about here. And part of the Social Security benefits may be taxable. So the basic rules on that is, once again, if there's a lower income, we don't want to tax as much of the Social Security, because the Social Security is a safety net payment. So the whole point of the Social Security is to provide for folks that have less income during the retirement. Therefore, if there's a lower income, we want to tax less of the Social Security payment. So if provisional income exceeds certain thresholds, 50% of the Social Security benefits are taxable. So as provisional income increases, the amount taxable increases as much as 85%. So bottom line, there's an 85% cap on income. So if there's a high income level taxpayer, they'll pay a maximum of 85% of the tax on their Social Security benefits received at the point of retirement. Okay, list of items from the employer excluded from taxable income. This could be a very interesting list. It could be something that you could actually go to your employer on a few things and say, this may benefit the employer and the employee in some ways. And the first one is an example of this. If we have an education assistance credit, notice that if you work for someone and the employer then says, we'll give you a reimbursement or pay for some schooling, some higher education, they could get a deduction of that. They may end up paying less taxes on that. And you and the employee would also pay less taxes on that. So these are things to kind of think about with the employer, because it usually benefits both sides of the employee and the employer. So these are types of things like kind of fringe benefits that we can receive and not include in income. And notice this is something that's gotten a lot of scrutiny, of course, over time for corporations, because corporations are always going to look for ways that they could try to pay their employees in such a way that it's not counted as taxable wages. And if they do that, they may be able to avoid things like paying the Social Security and Medicare payroll taxes, as well as the employee gets to keep more of their money, and therefore the employer, theoretically gets more benefit. Maybe they can pay less because the employee gets to keep more of their money. They're not paying taxes on it. So, the ways that are not able to do that, things you cannot do, are do things like give someone a car or something like that, or give someone expensive vacations or something like that. Those things are clearly income, so it doesn't have to be cash in order to be income. Anything we receive is going to be income, unless the IRS once again gives us the exception to the rule, one exception to the rule being the education assistance. So if our employer provides us with the education assistance, we don't have to include that up to a certain point thresholds within our W-2 wages. So we could have a discount provided to employees for products or services. So this is going to be the classic example. Is like if you worked for the airline and you got a discount on flights, mileage and stuff like that. That could be fairly significant to a lot of folks, and it could be something that would may possibly not have to be fully included as income. Then we got move-in expense reimbursements. So if you moved because of work and they reimbursed you for that, then that may be something that could be not included in the W-2. De minimis benefits, small items like a company picnic or something like that. So if there's going to be small type of items, a small prize or like a Christmas ham or something like that, or turkey, then or a small award, then there's going to be dollar limitations that are pretty limited, but to that limitation they are deductible, and as well as life insurance. Okay, list of other items excluded from taxable income. So outside of those type of items, what are some other things that are going to be items that we do not have to include in taxable income, even though possibly we got cash? So one would be scholarships. So if we got a scholarship to a higher education, that will generally not be included in taxable income. Life insurance proceeds are generally not included in taxable income. So if we received life insurance proceeds, from a life insurance policy, obviously, then that generally is not includable. Gifts and inheritance. So there's the reason that gifts and inheritance are not included is, well, one reason is because the reason they're listed together is because gifts and inheritance are going to be linked together because they're related to the estate tax, or sometimes called the death tax, which means that higher income individuals will have to count their money when they die and we call that the estate, and they'll pay taxes on that depending on the estate tax rules. And of course, if that was the case, and a very wealthy individual, or someone that was subject to estate taxes was going to pass away, one thing that would happen is they would then gift everything away on their deathbed, of course, and therefore avoid the tax because it was a gift before they died and they no longer have control of it. And of course now the IRS is going to try to regulate that and say, well, you have a limit to the amount of gifts that you can give, and if you go over the gifts, then it eats into your exemption for your inheritance tax. And for those purposes, they're linked. For the most part, gifts could be to anybody. They even include gifts to like our children and whatnot. There's a certain dollar limitation that changes from year to year that we're supposed to report if we go over that point, and then it eats into basically the inheritance tax. So basically, for that reason, the gifts are not taxable. If we get a gift, not an award, not a prize, I mean a gift, someone received something for no compensation other than just for a gift, and that will not be included, as well as an inheritance will not be included, because if the inheritance is going to be taxed, it's going to be taxed on the estate level. When the individual passes away, it's going to be taxed at that level. Child support, this is going to be an interesting one, because child support, when we receive child support, we do not have to include that in income because the person who paid it did not get it as a deduction. So this is going to be a point of contention a lot of times in a lot of divorces, in that if one spouse is paying another spouse in terms of the divorce, there's two things we can call that generally. Either it's child support or it's alimony, and there's tax benefits or tax differences to those two that should be aware of if that comes up. And if you're paying the payment, it's beneficial to the payer to call it alimony because they get to deduct it if it's alimony, but it's not good to the receiver because they're going to have to include it as income if it's alimony. On the other hand, if it's child support, then the payer is not benefiting from that because, of course, they pay it and it's not included as a deduction, but it's a benefit to the receiver because the person receiving it will receive income and not have to include it in as income. And of course, the reasoning on that is that if it's for the child, it's for the group benefit, rather than if it's for alimony, it's different. So I won't get into the rules on that, but it's a good item to know. It comes up quite often. So objectives. So at this point, we are now able to define income as it relates to the tax code, define and compare cash basis and accrual basis methods of reporting income and expenses, and list types of income, including taxable income under the income tax code, as well as list types of incomes that are excluded from taxable income under the tax code.